talking about chapters 14 and 15 in the textbook. I am your instructor, Brian Clark. For those of you who have not downloaded one of these before, welcome. This is the first session after assignment number 2. Just to be clear, we are not going to be reviewing assignment 2 in the recorded part of the lesson. So this recording is going to cover up until we review assignment 2, because obviously otherwise people could view the recording and then do the assignment, and that would not be fair to people. I mean, not you, of course, dear listener. You, I know, are scrupulous and honest and above board of all that. It's just a best practice, just to remove temptation from other people out there who might be having trouble. All right, so then tonight in our session we are going to be going through chapters 14 and 15 of the textbook. 14 is our final look at provincial topics for British Columbia, so I'm going to be reviewing, spending a few minutes with some topics which I think deserve a little bit more attention. And chapter 15, we talk about administration on the CRA side of things. What happens after we do a tax return? So we're going to be looking at that. And then the final third of the class or so, we'll have some parting commentary on the theory exam, which is coming up. And then for my students here, we will be reviewing assignment number 2. And anyone here who hasn't done assignment number 2, you'll have to excuse yourselves when we get there. All right. On that note, I've got 19 students here, so that's pretty close to quorum. So let's get into it. So, welcome back, everyone. My students here have had a week off to do assignment 2. And guys, just drop in the chat. How do you feel you did? Everyone feel reasonably good about assignment 2? No nasty surprises or anything like that? For those of you who just came in, I was very good, very good. Nice, glad to hear it. Yes, for those of you just joining us, I was having some tech issues with the chat yesterday, so if I seem a little bit more, I'm sorry, Onyema. If there's any questions you have about particular points with me, do let me know. As I mentioned, there was a typo in one problem which we did fix a couple weeks ago, but for students who perhaps did the assignment with that one piece of misinformation, then we can probably just shoot me an email and I'll see what I can do about that particular question. All right, but yeah, if you'd like to discuss it, do please email me and we can let you know. The main thing is that you did the assignment, though. Providing you do both the assignments and the exam, right? Even if you have a rough time with the assignments, you can still redeem yourself with the final exam. So don't despair. Don't give up hope just yet. All right. All right. As always, everybody, if you have any trouble with sound, let me know. Yesterday, I was having a lot of trouble with sound, as well as the chat, as well as everything else. So again, if anything comes up, just let me know. And Ali Reza, just say something, get my attention to let me know that something's going on. Sometimes it's just quiet because I'm thinking and not speaking, but I'll try to let you know if that's going on. All right, and as always, everyone, please ask questions. Interactivity is a big part of the course. Everyone who has downloaded this online, they don't have the chance to ask questions. So if something I say seems a little unclear, or you would like some clarification, or have an expanded question, please ask, because the people online don't get a chance to. All right. But in terms of class times, I am going to be trying to have us out of here by 9 o'clock. All right. So last time, just a reminder for everybody, we talked about topics relating to students. We talked about the types of income that are typically associated with students mainly. So taxable and non-taxable scholarships, some of the rules around those, the RESPs, the what they are, how they're set up, and what portion of RESP money is treated as income, and what can happen when an RESP plan needs to be wrapped up one way or another. We also talked about student loan interest, which can be claimed as a non-refundable tax credit. However, it cannot be claimed if there is tuition available to be claimed. Tuition has priority over student loan interest, and tuition credits are calculated on Schedule 11, the tuition credits are calculated on Schedule 11, as is the new refundable credit, the Canada Training Credit. So remember, the Canada Training Credit, this allows you to claim half of the tuition in a year, up to half of the tuition in a year, as a straight up refundable tax credit, dollar for dollar, and then the remainder of the tuition in the year can still be claimed as a non-refundable tax credit. This does confuse clients sometimes because this is relatively new. I had a lovely client last year, lovely woman. I won't say a word against her, but she phoned me up in a panic because she looked at her tax summary and said, only half of my tuition showed up here under tuition credits. And then I had a look at it and said, yes, but the other half is down here. It's a refundable credit. And she seemed pretty happy with that outcome. But yeah, it's still relatively new. A lot of people are unfamiliar with it and the rules around it. So it's a good thing to be able to explain to people. All right, guys, do you have any questions about student type topics left over from last time? As I say, anything to do with the assignment, we will be going through that at the end of class. I'm going to take a sip of water. All right, so on that note, let's press on. So again, we will look at assignment number 2 at the end of class. I will try to have you out of here by 9, but as always, I will keep things open if you want to ask questions. So I will take as much time as necessary to answer all your questions about assignment number 2. But if you do need to go by 9, it's perfectly fine. So tonight then, we're going to look at chapter 14, which is a short chapter. And it is intended to be flexible for the instructor because instructors for some provinces are going to have more to talk about than other provinces. And we're going to talk about some of the tax changes for 2025 that we are aware of. And then we are going to, in the middle third of the class, we're going to talk about chapter 15, which is administration. And we're going to talk about basically what happens when you submit a tax return and what happens after that. So to boil it down into oh yes, chapter 15 is much bigger than chapter 14. Yeah, so we're going to be going through what happens with the CRA review process, what happens when you want to change a return after it's been filed, the various avenues that you have to respond to assessments and reassessments, what happens when you owe the CRA money or the CRA owes you money, how is that handled? We're going to talk a bit about how refunds are sent out, and a little bit about elections. And again, in the tax sense of the term, remember, an election is a choice, an optional choice that the taxpayer has where they can choose to have something treated a certain way. And we're going to talk about what happens when you want to make a choice after the tax has been filed, basically. That's why it's coming up here. All right, so for chapter 14, then our objectives is so that you are able to list the provincial forms that need to be sent with the tax return and have some familiarity with the provincial credits in your province or territory, as well as being able to explain the changes expected for the 2025 taxation year. Now, we've already spent some time talking about the provincial forms before, so we're reasonably familiar with those, but some instructors have to deal with a lot more in terms of forms than we do here in British Columbia. I'm mainly going to be focusing on 3 topics which I think deserve some additional attention. As well for the tax changes, well, as you'll see, I think it's going to be a busy year. For Chapter 15, then, you should be able to describe how to submit your tax returns and just have a general sense of what happens after the CRA receives a return, the options that are there if you need to make changes to return after it's been filed, how interest or penalties are handled. You'll be able to talk about the general procedure for assessments, objections, and appeals, and have a sense of what the time limits are for refunds and elections. All right, so first, the provincial supplement then. So for the provincial supplement, just a reminder to you all, it can be handy if you have a chance to have a look at it as we go through, and we have looked at it previously in other sessions, particularly Chapter 5. Just a reminder, all the provincial supplements are laid out similarly. They kind of go through in a systematic way. They talk about the forms which are specific to British Columbia. They talk about the tax rates for British Columbia, the various non-refundable tax credits. One of them, the British Columbia caregiver amount, I'm not going to spend a lot of time on it here, but I just want to mention this is slightly different from the Canada caregiver amount because the British Columbia caregiver amount is only available for an eligible relative who is 18 or older. So there is no equivalent of the Canada caregiver amount for minor children, right? So this is a bit different from the federal amount. As with all of these sorts of things, you would want to have a look at it and see what applies. Notice that here, this is not an amount which can be claimed for the spouse, right? You can claim the Canada caregiver amount for your spouse or for a child 18 and under. You cannot do that with the British Columbia caregiver amount. The spousal amount instead is what you can claim. And the spousal amount, I forget if it is topped up. Right, so there's no provision to top up the spouse or common law amount if the spouse is infirm rather than disabled. Okay. So for the provincial supplements then, with any province, when you're dealing with it, you want to have a look and see what are the forms that are unique to that province. Now, what do we mean by that? Well, for some federal schedules, there is a corresponding provincial version in British Columbia, and they all take this format of the province's initials and then the name of the schedule in brackets. So you have the BC bracket S2 is the BC version of the Schedule 2, the BC bracket S11 in Schedule 11, and the BC bracket S12 is the Schedule 12. Different provinces will have different forms which are specific to that province. The key thing to understand with these is that they are a separate form that is in addition to the federal form. So if you look in your list of, where are we here? The list of downloadable forms that we've got sent for you. Oh, why? Sorry, it's not jumping out to me at the list. It is, of course, just, there we are, fillable forms. There we go. So for example, if you drop on Nova Scotia, they have a provincial version of the S2 and the S11, right? Other forms like here might be specific to a specific province. For BC, then the S2, the S11, and the S12 are the key ones at this level. So the Schedule 2, the BC S2, is for amounts transferred from your spouse or common law partner. I do not want that, thank you. No, don't want to deal with that right now, thank you. As you can see, it is similar to the federal Schedule 2 in that it is for amounts transferred from your spouse or common law partner, except of course that it is the provincial amounts. Key thing to note here, that there is a provincial age amount, pension income amount, disability amount, and tuition amount. Notice that these base amounts may be different from the federal amounts. They are taken from the BC 428 for the first three, and they are taken from the tuition amounts. So these would be a provincial transfer of tuition based on the student's tuition form. Notice here there are differences. So the pension income amount is a maximum of $1,000 provincially instead of $2,000 federally. Also note that there is no ability to transfer the Canada caregiver amount between the spouse or common law partners because there is no provincial equivalent. So the British Columbia caregiver amount cannot be transferred in that way. Otherwise, it follows the same basic outline. The spouse's income is compared to their credits. So any credits which have to be used to reduce their income, to reduce their taxes to zero are first used. Only the remainder can be transferred. That's the heart of this calculation here. This is quite similar to what's done on the Schedule 11. So if we look at the British Columbia Schedule 11, the BCS 11, you can see again that it's quite similar to the federal Schedule 11 with a few understandable changes. First of all, there is no provincial equivalent of the Canada Training Credit. So all that happens here is we enter the unused tuition from previous years, and then we enter the new tuition amount from the federal Schedule 11. This gives us the tuition which is available for the year. This is then compared to the British Columbia students' provincial tax credits. They are compared to the student's income. So if the student needs to use the tuition, they will. So again, it takes the credits up to line 40 of the Form BC 428, and then whatever's left after that, tuition must be applied. So again, tuition has to be applied before certain other things like charitable donations or medical expenses. So any tuition that has to be claimed is entered here, just like it is on the federal form, and then the remainder goes to the second page. Here. I see your question, UA Mod. Just hang in. I'll answer that momentarily. The back page is also simpler than the federal version, but it follows the same general pattern. We look at the amount of tuition credit that's available and how much had to be used, and that gives us the unused amount. Then we look at the new tuition for the year to a maximum of $5,000, deduct any that had to be used, and that gives us the provincial amount available to transfer. And again, this is what you can transfer. Box 17 is what they are transferring. And again, just like it is federally, the transferring the tuition is entirely at the student's discretion, legally speaking. Although, of course, spouses and parents and grandparents may have a different view of that. Anything that's unused carries forward to a future year. All right, as you can see, it's pretty similar to the federal Schedule 11. The main thing to keep, if it's a bit simpler, there's no space here to enter, say, disability or infirmity information. There's no Canada Training Credits, but otherwise it follows the federal pattern. The main thing to keep in mind is that the numbers here will often be different from the federal one. Just historically, British Columbia carry forwards tended to be smaller than federal because British Columbia's education amounts were smaller, is the short version there. All right. Now, you and I have a question. When we calculate federal tax, oh, yes, this is a good point, just to stress and to clarify. So federal tax uses the federal Schedule 2 and Schedule 11. The provincial forms are only used for calculating provincial tax and credits, right? That's exactly right. So the provincial forms are only used for the provincial tax and credits. The provincial 428, again, is for non-refundable tax credits and provincial tax, and the 479 is for refundable tax credits. One province, I think it might be Nova Scotia, does not have a Form 479 because it only has one refundable tax credit. So, and that's just calculated on the worksheet. But all of the other provinces, their 479s have their various refundable tax credits. The BC Schedule 12 then is what's used to calculate the home renovation tax credit for the, and this goes on to the BC 479. All right, I'll show you an example of this in a minute, but as you can see, it's very similar to the federal entries on the worksheet. For the home renovation tax credit, you just simply enter the date of the purchase or the service, the name of the supplier or contractor, the description of the goods or the service provided, the amount paid, and then you deduct any government assistance which applied, and if the credit's being split between eligible individuals, you deduct what the other person's split, and otherwise, whatever's left is a home renovation expense. More about this in a moment. So those then are the big forms to keep in mind: the S2, the BCS2, the BCS11, and the BCS12. Apart from the BC sales tax credit, which we've already discussed and is relatively straightforward, the big ones that I think we want to be familiar with, the big topics that I want to spend our limited time on, are the BC renters tax credit, the BC home renovation tax credit, and what happens when we are transferring BC provincial tuition amounts. So for the BC renters tax credit, key points: this was brought in 2023 and it is adjusted for inflation slightly. So in 2023, the threshold was $60,000. Oh, sorry, my point here is a little unclear. If the income for 2024 is $63,000 or less, you receive the full credit of $400. If the family net income is between $63,000 and $83,000, they will receive some credit, but the credit is reduced by 2% of the family's income above $63,000 until it reaches zero at $80,000. I'm going to show you an example. I'm going to take the family we looked at in CRP 12-1, Anil and Shri Kumaran. Now, their income was a little high to qualify for this, so I made a change. So assuming that they had an $8,500 RST deduction instead of the $500 in the problem, that would give the family a net income of $80,472.10. So if we proceed with that assumption then, and Anil and Shri should be over. There we go. Then we'll have a look at their BC 479. So for them, they're, of course, the BC sales tax credit, their income is far too high to qualify for that. But the renter's tax credit should show up here. So let's say the key things: it's necessary to enter your rental address for every address that was rented during the year. And the number of months that you rented is also important, because to qualify for the BC renters tax credit, you have to have rented a minimum of 6 months. Partial months do not count. Many of the problems we have in the textbook do not involve people renting, so that's why I went with Anil and Shri. They were renting for part of the year. Actually, I think it was only 7 months instead of 12, but the number of months here doesn't really matter too much, providing the total down here is more than 6. Similarly, the rent that's paid, so if you had 12 months rent at $1,000, the total of the rent that's paid does not matter, except that the CRA will want to check that the company or person the rent was paid to has reported that rent as income. So if the family net income is between $63,000 and $83,000, then the credit will be reduced. So it starts at a base of $400. Then we look at how high the income is over the base. So $80,472.10 in this example, minus $63,000, that would be $17,472.10 over the base. 2% of that is $349.44. So that is deducted from the $400. So they would receive a BC renter's tax credit of $50.56. So as you can see, a lot of people will qualify for this credit, particularly single taxpayers. Families, their incomes may be too high to qualify for this. The key things to remember, though, are that we need to have receipts for the rent, and they need to rent for a minimum of 6 months. But otherwise, the amount of rent they pay, although we record it, does not affect the tax calculation, and the number of months that they are renting, although we record it, does not affect the tax calculation. There's some more information in the textbook as well. So if we drop down here to the renter's tax credit, which should be right down here. And again, these credits in the provincial supplements are arranged in the same order you'd encounter them on the return. We have a handy chart showing how the credit is phased out. So the key terms with the credit is that it has to be eligible rent and it has to be an eligible rental unit. Similar to GST credits and the BC sales tax credit, to claim it, the renter has to be 19 years of age or older, or if they're under 19, they have to have a spouse or common law partner or a child. They have to rent for 6 months in the year, but they do not need to be 6 continuous months, right? So you could rent for 3 months at the beginning of the year and 3 months at the end of the year, and it would be fine. But it has to be a full month. Periods of less than a month do not count. Certain things will disqualify people from claiming this credit, but these are things which are fairly logical. So, for example, if you were in prison at the end of the year and were confined for more than 6 months, you cannot qualify. Because obviously, if you're in prison for 6 months or more, you cannot be renting for 6 months or more. Also, employees of a foreign country cannot claim this. People who emigrate during the year and are not a resident of British Columbia at the end of the year cannot claim it. And certain types of rent are not eligible. So rent for a campsite, a boat moorage, a trailer home pad rental, mobile homes, you cannot claim that. Lease or mortgage payments, so rent under a rent-to-own payment, cannot qualify. If the employer is paying your rent and it's not a taxable benefit, obviously you can't claim it. And if you are paying a relative, a non-arm's length transaction is the term for this. So if you're renting from your uncle or something like that, then you cannot claim it. It's not really a business arrangement. Now, for shared accommodations, if it's a case of spouses or common law partners, only one of them can claim the credit. It cannot be split. For tenants who are in a roommate situation, however, each of them can claim their own tax credit for their portion of the rent. All right, and then we have some illustrations in here as well. For eligible rental unit, again, if you're able to claim the homeowner's grant for the unit, it's not going to be an eligible unit. But here are the sorts of things that we can claim. Apartments in an apartment building, basement suites, carriage house, laneway houses, condominiums, detached suites, single-family dwellings, townhouses. In some circumstances, you can claim college and university dormitories, co-op housing, and employer-owned accommodation if the employer is treating that as income. Long-term care, assisted living, seniors independent living facilities. There's a special rule that if both you and the spouse each meet the criteria for the tax credit, only one can claim the credit, even though they're forced to live separately for medical reasons. This is slightly different than what happens with the British Columbia home renovation tax credit, which we'll touch on in a moment. Okay. All right. Any questions about the renter's tax credit before I move on, guys? I appreciate that I'm moving a bit briskly, but it is all in the provincial supplement. The key points with the renter's tax credit is it's relatively new, so a lot of people don't know about it yet. Because it's relatively new, it's a little unclear exactly what the province would require for documentation or receipts, but we've been proceeding under the assumption that we don't necessarily need a copy of the renter's agreement, but we do need some kind of statement saying that this amount of rent was paid to rent this apartment for this many months in the year, signed off on by the landlord, or be reasonably satisfied that that can be provided. Okay. Okay, everybody good? Give me a heck yes in the chat if that's all clear. Excellent, fantastic, good stuff, good stuff. I'm just paranoid after that bad experience yesterday. Okay, so the BC Home Renovation Tax Credit. Let's touch on that. So this it has an interesting history, not all of which is relevant if you're not a tax nerd, but basically it's been around for a few years, and it was around in some years when there was no equivalent federal credit. The federal home renovation tax credit is a non-refundable credit. The British Columbia one is not. It's refundable. It is a tax credit of 10% of the first $10,000 of renovations, and it has slightly different definitions than the federal credits. So I'm going to show you an example from CRP 10-1. There we had a case where we had the Easts, and they had a $2,900 stair lift that was installed by Affordable Stair Lifts. So let's look at what that would look like. So for the Easts, and I believe for the Easts, that would be not going to be like that, is it? That's fine. That's fine. Should be in my downloads folder. Okay, right here. Adam, okay, that's this should be the newer one. There we go. All right, so let's have a look then at is BCS 12. So again, you can see just like with the federal credit, the date is entered, the name of the supplier contractor, the GST number, a description of what the thing is, and then the amount that's paid. If the government paid for any part of it, it would be deducted here. And if the credit was being split between the couple or other eligible individuals, whatever else was claimed would be deducted here. Otherwise, we're left with $2,900 in home renovation expenses. And note that there is a spot at the bottom. If the residence is different from the address on the return, then you don't tick this box and enter the other address. All right, so the Schedule 12 then gives us the information which goes into the BC 479. So it comes right in here. So notice that if the two spouses or partners occupy separate principal residences for medical reasons, and they are both claiming the home renovation tax credit for seniors and persons with disabilities, then you tick that box to let the CRA know that the couple is living apart. So the home renovation expenses from Schedule 12 are entered here. 10% of that, in this case, would be $290. And so the $290 then will show up on line 47900 of the return. Okay, now what was that about principal residences, you say? Well, the rule is slightly different than it is for the renter's tax credit. Remember, for that one, if the couple is living apart due to medical reasons, they cannot both claim the renter's tax credit. But for the home renovation tax credit, it's different. Initially, the credit was only available to seniors. It was brought in 2012. But then in 2016, it was expanded to persons with disabilities. So all tax returns that we're currently able to do, you can claim this for either case. The key difference here with the federal credit is that it is available to tenants as well as homeowners. It can also be claimed by family members who share a home with a senior or person with a disability. Otherwise, the criteria are what you expect. The taxpayer needs to be 65 or over. They need a disability tax credit certificate, or they're a family member sharing the principal residence with a taxpayer who is eligible under the first 2 points. Crucially, provincially, the principal residence is not the same definition as it is for federal tax purposes. Here, crucially, it includes rental accommodation. So principal residence here is defined as any premises, including a non-seasonal mobile home, that's occupied by the individual as the individual's primary place of residence. So this includes rental property, but does not include properties such as cottages that are occupied for only part of the year, right? Remember, for the federal principal residence designation, you can claim something like a cottage if it's occupied only part of the year, because so long as that is the only property which you are claiming as a principal residence. So this is a key difference. The renovations otherwise need to be eligible renovations, and these follow the same general rules as the federal rules. It cannot be done to improve the value of a property. It needs to be related to disability or improving accessibility, and so on and so forth. But otherwise, the general rules follow the federal pattern for what is and isn't eligible. So spouses and common law partners can split the amounts, and if they have to live separately, both of them can claim. All right. Otherwise, more information is here in the provincial supplement if you encounter a renovation in British Columbia. Last thing to touch on is BC tuition transfers. I'm not going to go into the provincial supplement for this one, just in the interest of time. But the two key points are tuition, of course, provincially is kind of a patchwork right now across the country. Many of the provinces are doing completely different things, and several of them do not have a tuition credit at all. BC, however, is a bit advantageous. If you move to BC, your provincial carry-forward amount will be set to equal your federal carry-forward amount. So for most students moving to BC, this means their provincial carry-forward amount will increase. In some cases, it might decrease, depending on the province they're coming from, but most of the time it will increase. Even if they are coming from a province which has no tuition credit provincially, so long as they have a federal carry-forward amount, they will receive a provincial carry-forward amount to equal that. Now, if you are transferring tuition to BC from another province or from BC to another province, all of the provinces have individual rules. Obviously, provinces with no tuition credit provincially, it probably can't be done. But for other provinces, depending on the province, there may be different rules covering the calculation. Manitoba and New Brunswick, I remember particularly, are called out in the supplement. In general, typically what has to happen is the credit is recalculated as if the student or the transferring student or the receiving taxpayer was a resident of the other province. So again, just keep in mind, it's not straightforward for any given province, any given situation where this comes up on. You should review the rules in the provincial supplement. All right. Now, let's talk about tax changes for 2025. And I don't want to eat up a huge amount of our time here, but I will try to give you a general sense of what's going on there. Now, for this, it's largely in the textbook, for the very good reason that tax pages for 2025 are not finished yet. The government always has the ability to make tax changes pretty much right up to the end of the year, and sometimes after the end of the year. So this is one of the reasons in this course where we are always teaching the tax theory from the year previous to this one. So even though we are here in 2025 now, we've been talking about the tax rules and tax rates for 2024 because 2025 still could change. If anyone in the future has downloaded this session, that's why. We're always talking 1 year in reverse, which can get a bit confusing in the tax office, frankly, when I'm talking to a client and I'm talking about this year or that year, and they say, wait, do you mean like this year now? And I say, oh, no, I mean the tax year we're talking about, because we can talk about it because it's completed. So let's have a look at the textbook and just go over some of the highlights. Okay, so for chapter 14, the tax changes. The ones we have in the textbook are the ones we were aware of at the time of publication. And there have been developments since the publication, because the federal government dropped a budget, I think last week, very recently. So we, as a company, are still going over it and figuring out what some of the implications are. But we haven't changed the textbook yet because the budget is always a proposed budget. There's a possibility it will not pass, with all of the excitement that entails. So until a budget is passed, has received royal assent, any changes should be understood as tentative and proposed. But here are some things which are kind of locked in. So the various tax brackets are indexed for inflation. So they increase by 2.7%. So for example, the bottom tax bracket is going to become $57,375, and under the top one is going to increase to its $253,414 and over, and so on. One big change, however, is that the bottom tax rate of 15% is going to be lowered. This was announced in the budget, and there is some talk about how it's coming in and is being phased in. So for 2025, the first part of the year was at 15%, but then there's going to be a lower rate for the second half of the year. We're still getting the details about how this is going to work in practice, because this has obvious implications for things like tax credits, which are at 15%. And my understanding, but although I haven't had a chance to go through the details in great detail yet, is that there's going to be some sort of bridging credit to help people who have things like charitable donations, where they might be losing money on their tax credit because they didn't claim it under the old rule. So there's probably going to be a transition period of a year or two where we have additional rules about handling things like that. But yes, the plan is for the bottom tax bracket to be lowered. So if that does, it will affect the credit which is received for the various tax credits. But what is locked in is that the federal personal amounts and various other tax credits are going to increase by this inflation indexation factor. So for 2025, then, the maximum basic personal amount is going to be $16,129 or $14,538 if you're in the very top bracket. The age amount is going to go up, and the income threshold with it is going to go up. The maximum spouse, common law partner amount is going to go up. As you can see, most of the personal amounts are indexed for inflation. The volunteer firefighters amount, this is not indexed for inflation, but notice that it increased from $3,000 in 2023 to $6,000 in 2024. The Canada employment amount has increased slightly. The pension income amount, however, is flat. It remains at $2,000. It is specifically not indexed for inflation, but most of the other things that we deal with are indexed for inflation. CPP and EI are always interesting because the income thresholds are indexed for inflation, and so the maximum earnings for these calculations have been increased. But the basic exemption, however, remains at $3,500, and it has been at $3,500 for many years. The rate is unchanged at 5.95%. So the rate stays the same, the maximum earnings stay the same, so the maximum contributions, therefore, are increasing from $3,867.50 to $4,034.10. The CPP2 tier is widening. So in 2024, it was only about $5,000. In 2025, it's going to be a little under $10,000, but the contribution rate is going to stay at 4%. So in 2024, then, the maximum contributions were $188, whereas in 2025, it's going to be $396. EI, the EI rate is going to decrease Quebec has a slightly different rate, but it's decreasing there as well. Remember, for Quebec, EI is essentially two programs. EI is just for employment insurance, and the PPIP is for maternity leave and similar ones. So here, again, the rates are decreasing, but the maximum insurable year earnings are increasing. So as a result, the maximum amounts are increasing as well because the earnings thresholds are increasing. RRSPs, the maximum dollar limit for RSP contributions is being increased, but the rate remains at 18% of earned income. For TFSA contributions, it's going to be an additional $7,000 in 2025. So anyone who's never contributed to a TFSA and is at least 34 has a limit of $102,000 in their TFSA plan. For social benefits repayment, that's indexed for inflation as well, so those thresholds are moving up, and as well for the refundable medical expense supplement. The GST, HST credit, those parameters have increased, so the basic annual credit for a single taxpayer is going up to $349. There's a complete list of changes in facts and figures. The Canada Child Benefit is also indexed. The main thing that people are going to notice around refundable credits, I think, is that the Canada carbon rebate is going, and the British Columbia equivalent are going away, so people may notice their absence. All right, so as we note here, there can still be more changes or additions prior to the end of the year. So the federal budget had a variety of changes, many of which do not affect this level. One thing which would be of interest is, for example, they are going to be changing it so that home renovations cannot be claimed as a medical expense in addition to being claimed as a home renovation. This would bring them in line with other tax credits, right? But again, all of these changes are proposed. They are still tentative as of this point. If you come to work for us in February, we have a detailed seminar for all our employees to let them know what the changes were that have been actually approved for the 2025 tax season. And usually that's the last word on it. There have been cases in recent years where the government has walked back a change during the tax season, so and those are a headache when that happens, but that is a problem to worry about at that time. All right. Okay, good. So that then is chapter 14. Let's move on to chapter 15. And again, as always, there's a bit more detail in the textbook, or at least links to point you at where you can find more information. All right. Chapter 15, then, we are dealing with administrative. What elements of tax returns? What happens after the tax return has been completed and sent into the CRA? This will probably take us up to 7:30 or so, I think. We will keep an eye on the time. All right. Now, again, if you've got any questions, guys, just toss them in the chat, because some of this, I think, tends to generate questions of interest. The first thing to be aware of when you submit a tax return is that paper is still relatively common. To give you some idea of the numbers involved, so as I'm sure you all know, the population of Canada is around 41 million. Well, in 2025, between February 7th and May 20th, students, put your guesses in the chat. How many tax returns do you think were filed between February 7th and May 20th? Total tax returns. Given that Canada has a population of 41 million. 25 million? Any other guesses? 32 million? 18 million? 20 million? 35 million? I should apply Price is Right number rules here, and the person closest to, without going over, gets some kind of prize. But in fact, 30 million is quite close to it. So the total returns received in this period were 29,888,910. So just under 30 million. If that seems low, remember that this is only up until May 20th. So a certain number of people file their returns late, sometimes quite late. But these are the totals that were received during this time period. And of course, some people, like children, particularly children, say, do not file tax at all. So this accounts for why you will not have 41 million people filing their taxes. So a certain number just don't need to file taxes and won't file taxes. But yeah, around 30 million taxes. Now, of that 30 million or so in tax returns, how many do you think were filed on paper? Take it 4 million, 2 million, 8 million, 10 million, 9 million, 15 million, 1.5 million, 1.5 million. Yeah, actually 1.5 million is reasonably close. The majority of tax returns are now filed electronically. Paper returns counted for about 1.8 million, or about 6.6% of the total. Now, what I want to stress here is that's still a quite large amount, right? That's still a pretty large number of paper returns. So when the CRA does things like redesign a tax form or change a process so that you don't need to submit a certain schedule, it's important to keep that number in mind. About just under 2 million returns, 1.8 million paper returns. Every paper return has to be picked up and handled by a human being. So if the CRA makes a change to their tax forms, which reduces, say, the total number of pages that need to be submitted by a page, that's 1 million pieces of paper less that they have to deal with. So a lot of CRA policies make sense then if we simply understand the scale, right? There's a reason they do not want you to send in receipts right away, only if they ask for them, right? Because of the sheer scale of the problem, the sheer number of returns that have to be dealt with. So for returns that are paper filed, and it's important to bear in mind, for the average taxpayer, you absolutely have the legal right to file your return on paper if you want to. That remains a free option you can do for the price of a stamp. The government would very much like it if everyone could file electronically, and they are trying to smooth the path so that more and more and more returns can be done electronically. But there's still about 1.8 million that are done on paper. And that will remain popular, I think, for the foreseeable future, at least popular enough. When you file the tax return on paper, you print out the main tax form. If you're doing it using computer software rather than longhand, typically the software will generate a short version of the form where the middle data entry pages are kind of condensed. So the typical T1 would be compressed to 4-page version. And then all your schedules, forms, slips, and required documents that are supposed to be sent in, these are attached to page 3 of the return. Page 3 for these compressed versions usually says KFS on it or something similar for key field summary, and it just has a list of all the various lines that should have a number on them. So remember the guideline, if something is a schedule, it should be attached to the return and sent in. If something is on the worksheet, it doesn't need to be sent in. Various other forms and slips, it will depend on what the form or slip is. Typically, you will send in at least your T-slips, as well as your provincial 428 and 479. If there's a schedule like a Schedule 3, you would attach that. If there's a supplemental form like a T778, you would attach that, and so forth. When you are mailing in your return, you can attach a check with the return if there's a balance due made out to the Receiver General of Canada, and then that will be assumed to have been paid on time, even if the return is, so long as it's postmarked by April 30th. Oh, I see a question. Yes, hang on. So you're asking about the standard Canadian records retention period. So if something is filed electronically, we'll get there in a second, Kate. It's a good question, but I'll answer that in a second. So for e-file and net file, this is when we file electronically. And again, for anyone who missed that when we touched on it earlier in the course, e-file is when a return is filed electronically through a third-party provider such as H&R Block or some other less well-known tax company. And NetFile is when you do it at home with do-it-yourself software. But with eFile and NetFile, although you're obviously not submitting your receipts with the return or your forms, the expectation is that you will hang on to those documents. This is also true for paper filing as well. You should keep a copy of everything that you send to the CRA. It might get lost, so keep a copy of everything. And the standard Canadian records retention period is 6 years. So when we e-file something with the CRA, they say, please tell your clients to hang on to things for 6 years. But we're in the tax years 2024, right? So it would be 6 years from the year we are in, I would say. So 2025, keep it for another 6 years after this year. So if you want to include the year you're in, make it 7 years. Now, for reasons which become clear momentarily, it may be advisable to hang on to them for 10 years, but most Canadian businesses, banks, things like that, are not required to keep records beyond 6 years. This can often lead to problems when you need to do something that is older than 6 years. But e-file and NetFile collectively account for about 94% of electronic returns. You may have heard there's a new service called SimpleFile, which is aimed at taxpayers with extremely simple tax returns who can just do it over the telephone or similarly. But that is still not very well known, not very popular. Many people are not eligible for it. That's less than 100,000 returns. So I would, it's not currently in wide use. I would expect that it may expand in years to come. It is mainly aimed at people whose returns are extremely simple, who only receive income from government sources, such as old age security or CPP, and so their income is very stable. They are not typically claiming credits, and they simply need to file a return in order to get government benefits. So the government would like to just kind of speed up and automate that process, is where the CRA is coming from. From H&R Block's point of view, we feel that the CRA should perhaps be pushing its resources more towards more promptly handling things such as paper filing or helping people online. But that is H&R Block's point of view. Personally, I think both things are probably worthwhile to pursue. The upshot is that for anything involving personal attention, such as a paper filing, essentially it requires there to be a human being at the other end to deal with it. And that has some implications for processing time, as we'll get into. When you submit a payment then, if you don't send in a check with your return, there are other ways to do it. You can do it electronically using a system called MyPayment. So that you access through the CRA website, and you can do it using a bank card which has, for example, one of the following logos: Visa, Debit, MasterCard, and Interac. You can do it using telephone or internet banking, just like you would with any other bill. So just like you pay the hydro company, you can also pay the CRA. Just add them as a bill payee. You can also do it by mail, sending in a check with a paper return, or a remittance form called a T7DRA. And again, that's just essentially like the form that you would submit when you're paying a bill for for a utility company. You can also take that form into the bank, and they will treat it like any other bill payment. Pre-authorized debit, that's one you can do with when the return is submitted. Essentially, you tell the CRA to withdraw a predetermined amount from their account on a certain day, and that needs to be at least 5 business days after the agreement date. In total, the CRA lists 11 different methods of payment on their website. So if you have time, you can have a look at that if you're interested. Just Google CRA, how to make a payment to the CRA, and the CRA is happy to help. But these are kind of the major ones. The key takeaway, though, is as long as any balance that is owing is paid by April 30th, no interest is charged. So then, what happens after the return is filed? Why is credit card not listed? It is through MyPayment. Right, it's through MyPayment, so you can do that using Visa Debit or MasterCard Debit. Right, I don't think they're allowed to take credit card payments themselves, but yeah, Visa Debit or Debit MasterCard, they are able to. I'm not sure why credit cards are generally discouraged. I feel the government position is that they do not want people to be incurring high interest debt in order to pay low interest debt, because as a policy matter, because CRA interest is always going to be less than credit card interest, if you follow me. So I think they may actually be keeping that in mind, but that's just a guess. I am not, and I have never been, a Minister of Finance. Okay, so what happens after the return is filed? So whether it's electronic or on paper, the returns are always processed in the order they are received. Depending on the complexity of the returns in front of your return, this will have an effect on how quickly something is dealt with. Electronically filed returns are simply assigned to the queue when they are submitted. Paper filed returns, however, require personal handling by a human being. So they undergo an initial assessment just to make sure that they're not going to cause problems when they are submitted, and then they are entered into CRA's computers. So anything involving human intervention tends to slow the process down. And as you can imagine, some paper returns might involve needing to decipher handwriting or things like that. Some paper returns, for example, prepared by commercial software through a company like H&R Block, would sometimes have a barcode on the front, which the CRA can scan. It kind of changes around from year to year, but the common factor is that any paper return requires extra time because it requires human intervention, at least at some level. Then those paper returns, once they've been processed, they are labeled and filed away and kept by the CRA for 6 additional years. And notices of assessment are sent out once the processing is complete. So, in general, what we have observed over the years is that there is a solid 10 to 14 business days of processing time from the time the CRA receives an electronic return and the notice of assessment is released. Not everything that happens during that process is public knowledge. The CRA kind of keeps it close to the vest exactly what their internal processes are. But this is what we've been able to observe, and the textbook has some more information, but basically The CRA does not, for security reasons, does not publicize its inner workings very much as an organization. Now, there are certain circumstances that can be longer. So if the CRA, and we'll talk more about that on the next slide, but for the majority of the returns, if no immediate errors are detected, then they are going to be assessed as filed. So for the paper returns, even, once, they are reviewed to make sure that they will go into the computer and not cause problems, that same 10 to 14 days applies. It's just a matter of when is a human being able to get to the return to put it into the queue. So in general, for electronically filed returns, it's 10 to 14 days usually, but paper returns, because of that extra human time, can take at least a month to process, and often will take longer depending on the complexity of the return. For paper returns, it also has a lot to do with how busy the CRA is at that time. So if you submit it relatively early in the tax season, often they'll be able to turn it around in a month or slightly less. But if it's during the busiest time of the CRA year, it can take longer. This also kind of applies to adjustments, which we're going to talk about a little later on, because those require human intervention as well. So if it's a paper adjustment, you have to allow some time for that. Okay. So then, during this processing, the CRA may select a return for what's called a pre-assessment review. So it is the CRA's practice to select certain types of review, certain types of returns, or certain types of deductions for review, either at the time of processing or at a later time. If it happens at the time of processing, it's called a pre-assessment review. Basically, the return is stopped, and the CRA says, we will not process this return until we receive this specified information. So sometimes they'll send a warning that they might do that, and then they do not actually request the receipts, but if they do request it, it'll usually be in the form of, we cannot process this return until we receive these receipts, these medical receipts, these moving receipts. Some years ago, I did one for a client where it was transit receipts, and so then you have a month to submit these in order for them to complete the process for this return. Generally, these returns are flagged because of a possible risk of some sort of non-compliance. However, the CRA, in the majority of cases, a return is assessed as filed. It's just a matter of them putting it through, processing it, and then they accept it, and they make any corrections that they need to, that they can detect, like basic corrections and things like that, and then they send out the notice of assessment. However, some returns may be reviewed later. So there's kind of two streams to this. One is what's called a post-assessment review. So this usually happens and the CRA has up to 3 years to do this. So just because you don't receive this immediately, you can't assume that the CRA is not going to do this. Typically, certain types of returns or deductions will get reviewed later on. So moving expenses, say, tuition expenses, say, they'll send out a letter and say, hey, we would like the supporting documentation for this or that. Sometimes these checks are not so formal. As I've mentioned, I don't know if I've mentioned in this class, when I had some foreign pension income that my wife was receiving, all that happened was I got a call from the CRA, and they said, hey, Brian, what is this? And I said, oh, it's a government pension from Missouri. And they said, okay, that's fine, carry on. And they didn't even need any documentation. But more commonly, they will say, oh, you have moving expenses for $20,000. That's a very large number. Can you please send us your receipts? Or how is this arrived at? And if you do not respond within 30 days, that's a good question, Ali Reza. After 30 days, they can reverse the claim. Now, it is still possible, and I've talked to many CRA agents over the years, it is generally still possible to send in the documents late, and they will put things back at that time. But after 30 days, say, if they ask to see your tuition receipt and you don't provide it, they will disallow the tuition claim and they'll remove it from your tax return until such time as you provide it. Right. So it's absolutely possible to send in stuff later. It's just that at that point you will be reassessed in the meantime. And then after that point, what's happening is you are trying to reverse the reassessment. And that can be done either by responding to the original letter or sending in a new adjustment, depending on the situation. CRA review process, generally they can go back, they have up to 3 years to go back. However, if it's a case of criminality or gross negligence, they can go up any number of years. So if you are committing crimes, that casts a long shadow. The matching program we mentioned here, what this is when, think about T4s, right? When a T4 is received by employees, typically the company has also sent a T4 to the CRA. So what happens in the matching program, and this usually happens in the fall, in the winter, the CRA goes through, by that point, should have all the T4s, for example, so they will go through for various taxpayers and say, oh, okay, this taxpayer says they have 5 T4s, and we only have 4 T4s here. What's going on there? Where's this missing T4? So they'll get in touch with the taxpayer. Or the reverse, the taxpayer will have 3 T4s, and the CRA will go, wait a minute, we have 2 more T4s for this person that they didn't report, and then they will add them in and do a reassessment at that point. Or, has happened to me once for reasons I still don't quite understand, but I figure it was some kind of math error, and they said, oh, the numbers you've submitted here don't add up. There's been some kind of math error. Can you let us know what's going on here? Because it should be this amount. But to this day, I'm still not sure exactly what happened there. And it's been more than 10 years, so I'm not going to be able to go back and have a look at it now. But it seemed generally right. So, all right. Now, this one. So if 30 days pass, it's still possible to submit documents. But in general, it's important to know this figure. So let's get our poll question here. And let's see, this is a good check to see who had a chance to actually read the chapter. So I've probably mentioned this before as well. So how many years can a taxpayer go back to make a change to a return? Is it 3 years, 5 years, 10 years, or is it any number of years? So, and if you haven't had a chance to read the chapter, by all means, take a guess. As always, this is not a test. It's just for fun. I can see that the correct answer is the most popular answer, but many people still haven't taken a guess. I encourage you to take a stab at it, because again, I'm not marking it. It's perfectly fine. Very good. So the correct answer is 10 years. For reasons which we will get to a little later on, and most of you had that answer correct. All right, so 10 years is the correct answer. So when we want to make a change to a return which has already been filed, you can request an adjustment using Form T1 ADJ, ADJ for adjustment. It's a T1 adjustment request. If you're doing it on paper, you use the form. In recent years, it's been possible to do basic adjustments online, and I think you can currently go back the full 10 years. I think when this ability was first brought in, it was a bit more limited. You can only go back a few years. But in general, you can go back for any of the previous 10 calendar taxation years. Depending on what the adjustment is, it may or may not require supporting documentation. Supporting documentation can be scanned and submitted electronically, but usually you have to wait until the CRA requests it. The CRA will not amend a return, generally speaking, to change discretionary deductions such as claims for capital cost allowance or things like that. And this is one of the reasons that you cannot go back more than 3 years to make a change to pension income splitting, because it just makes things too complicated. So discretionary deductions like that, they generally do not allow you to go back and change, or capital losses being applied or things like that. Now, it's important to understand that adjustments are also an important part of the process. It's important that we have this ability, because sometimes when we get the notice of assessment from the CRA, it may have a mistake. Many taxpayers don't read their NOA carefully, and this can be a serious error because the CRA doesn't always get it right. I had to deal with a situation with an estate once where they mishandled something. I could tell what had happened, some kind of computer error, but because this happened in the throes of COVID, I had to spend about 2 years trying to chase a human being to actually help with it. And the first time they fixed it, they only half fixed it, and then I had to send back another, politely get in touch again and say, hey, please read this letter, and then please look at this result and see the problem there. So, in general, though, any change that the CRA makes to the return after it's been submitted and then it is recorded in the notice of assessment that they made a return, it's very important we should look at it carefully, and any change that isn't in the taxpayer's favor, we should evaluate it, and if it's unjustified and if it's worth our time, a request should be made to the CRA to correct it. So when we make changes online, it's generally good practice to prepare a Form T180J in advance, just so you have a record of the changes made, because when you are entering the information online, you have to do it by line number. You have to say, I want to change line, a given line number. I want to change, let's see, line 21200 to include these union dues. So the old number was 0 and the new number is $500 union dues, for example. So in order to keep track of all those, it's good to prepare the T180J first in order to have it all on record. Now, other things to be aware of. Note we say basic adjustment here. So not all lines can be changed online. And it is also not possible to make changes to personal information. The T180J, when you send it in, Part A is for personal identification information for the taxpayer and the year that's to be adjusted. It is not possible to change things like address, residency, or citizenship using a T180J. That has to be done separately. The T180J is purely for numerical changes to line numbers. So you also do need to indicate whether you're using the same address as the return or enter a new address. Because obviously, if you're making a change to a return that's 5 years old, the person may have moved. So you want to make sure the CRA understands what the actual address is currently. And this could be quite different from what's on the return. Authorization, Part B, this is used if a representative, such as someone from H&R Block, is filling in and signing the T180J. Most tax professionals with a certain level of authorization are authorized by the client to go on in line and make adjustment changes, directly through Represent a Client. So this isn't a case, for example, where you need power of attorney to act. You, as the tax professional, are authorized by the client to go in and essentially correct mistakes. You can't, although this is a federal form, you can also use it to change provincial lines. You just simply need to specify the provincial line involved and how much it's changing by. So in Part C, then we enter all of these lines, federal and or provincial, that are going to be adjusted with the previous amount, how much it's changing by, and the revised amount. This is rounded to the nearest dollar, which, so if you're entering it online in the website, you can only put it in round dollar amounts, which can sometimes lead to odd effects. Sometimes when I see clients' tax information, I download it, they'll have odd things like a $1 tuition carry forward or a $1 RSP that hasn't been claimed, and this is because of this dollar rounding. So, but as long as you have that in mind, it's not too hard to handle it. Notice that it's not typically necessary to submit receipts when you're making the online change. You cannot send them in preemptively. The CRA's policy is that if they want to see the receipts, they will ask you for them, and so you should submit them at that time. Some things, however, they are pretty clear. They are going, like, for example, if you are adding additional medical expenses and you have not claimed medical expenses before, they are pretty clear that you will need to provide all of the medical receipts for all of the medical expenses at that time. Part C, you also will enter an explanation or additional details. However, this needs to be brief and clear. The way we kind of explain it is that we should consider that this is for the other person at the other end, and you're telling them what is happening and what you would like them to do, and you should ask them nicely, but they are not interested in explanations such as, oh, this arrived late due to circumstances and we're very sorry, and so on and so forth. That is not necessary. It should be straightforward and to the point. Remember that person at the other end is someone like me sitting behind a desk in a warehouse with a giant stack of adjustment requests, and that person just wants to get through them relatively quickly. So it needs to be simple requests like, please include this T4 with the return. Please make this or that change. In cases where more information is required, a second note can be attached, but it should be brief and clear as possible. So if you're making an unusual request, say, or if it's a case where the necessary change isn't clear and you need to specify what's going on, a separate sheet or note is fine. Just keep it as brief, concise, and clear and to the point as possible. And lastly, Part D is the signature of the taxpayer or the representative. That's pretty straightforward. So using Represent a Client, again, this is when we tax professionals go online to make a change for someone. This is generally going to be the better way to make an adjustment request because the electronic requests are processed faster than mailed adjustment requests, again, because those require human intervention. Even to the extent that an online adjustment requires human intervention, it doesn't require them entering things manually into the computer. They can just look at what's been submitted and they can say, oh, yes, this makes sense. Immediate confirmation and tracking is provided when you submit it electronically, so this is an advantage of this service. But again, you should complete a T180J before you start so that the values you need to change are going to be known. And again, depending on the type of the adjustment request, the CRA may request further information or verification or receipts, and that's fine. You just can't, generally speaking, do this preemptively. Now, things to keep in mind, if you're adjusting multiple years, you can, depending on what you're doing, you can often make multiple adjustments all at once, but you need to enter the years in sequence. You need to enter all of the years before you hit submit. because if you don't do that, then you cannot make any further adjustments until all of the previous ones are processed. So but again, sometimes it's necessary to be tactical about this. If you're submitting on paper, say, if certain adjustments need to be approved before other adjustments can go through, then you might submit them at different times. It's something to consider. And submitting the documents, again, it's a simple matter of scanning and uploading them using the Submit Documents feature. Currently, the T180J itself cannot be scanned and submitted when making a change. Instead, the individual lines are changed one by one, but the form should be prepared in advance, again, as a tool to help you keep track of the changes you need to make. Most CRA tax offices, I hesitate to mention this, but most CRA tax offices do have a fax number. So in cases of, say, a postal strike where you really need to make sure something reaches the CRA, that is something you can use in situations where a standard method of submission is going to be impractical for some reason. But it's generally, it's not encouraged, let's put it that way. They still have the fax number, but they would much rather receive it electronically if at all possible. And if you're submitting it something by letter, that's usually superior to fax, where you can't really always rely on the quality of the transmission. But, if there's a postal strike and you're coming up on a deadline and you really need to make sure the CRA gets a document, fax can be very useful for that. All right. What time is it? It is about 7:30, so let's take 15 minutes. After the break, we will finish off Chapter 15, and then we will let our online friends go, and we will go through the assignment at the end of class. All right, but let's take a break. Any questions before we break, guys? Are you all good? Okay, so let's break until 7:45. Ali Reza, just pause it there, and we'll just unpause it, and we'll keep going. Very good. Welcome back, those of you online. We've just had a 15-minute break here. All right, so another poll question to see who all has read the textbook. So this is about Refile, the service called Refile. And of course, those of you online, if you want, you can go look this up, or you can play along at home. So true or false? Refile is available for all taxpayers. All right, let's see what you think. Oh, okay, and I can see that most of you have got the correct answer. Good. The correct answer is false. It is not available to everybody, but it is a good example of something to give you an idea of the kinds of things where electronic services generally might not be applicable to. So let's have a look at the textbook here. So escapee, and there we go. And let's have a look at the refile service here. So when we look here, so currently it's only available for certain years, 2021 through 2024. The overall advantage of the service is that it's faster and overall more efficient than simply updating a return rather than preparing and submitting a T1 adjustment request. So what basically happens in a refile is that you use your existing tax software to simply prepare the return again and then resubmit it rather than doing a whole second adjustment process. So if someone qualified for this service, say if they had their return done at some other company, they could just come into you and say, oh, hey, can you just do my return again, but do it right this time? And then you could simply refile it. So an amended tax return then can be simply e-filed if it meets the e-file requirement. But for returns that aren't eligible for refile, then a T1 adjustment request should be done in the normal way. The big complication here is that not all software and programs support this service. Under normal circumstances, the CRA, until refile was introduced, the CRA had the main concern with the CRA is that you would accidentally submit the same return twice, and so they put in all kinds of safeguards to make sure that you couldn't submit a return once it had actually been submitted. So not all software currently is compatible with refile. But to give you some idea of the things which might prevent you from using refile, so the requirements here, for example, give you some idea. So the taxpayer needs to grant a certain level of authorization to the representative. The original return needed to be done electronically, and the taxpayer cannot have a reassessment in progress. The original tax return assessment has to have been completed, and there isn't a refile exclusion. So there are certain e-file exclusions, and so there are also refile exclusions, things which cannot be filed electronically. Many of the things which cannot be filed electronically also cannot be refiled, but there's a slightly longer list here for refile. To give you some idea, it tends to be things which would be a little more complex and require human intervention. So applying for child and family benefits, allocating the refund to different accounts, if someone is subject to provincial or territorial income tax in more than one jurisdiction, it's an international or non-resident taxpayer, so someone who left Canada during the year, modifying an initial return that was arbitrarily filed by the CRA, a pre-bankruptcy return, carryback amounts such as capital or non-capital losses. As you can see, these are fairly complex things. So there are certain things which cannot be electronically filed to begin with, and then a slightly longer list of things which cannot be refiled. So, however, I think it is important to note that the CRA policy is that if a return can be electronically filed by a tax preparation company, it must be. So, for example, at H&R Block, if we electronically file a return that the CRA deems should have been, if we paper file a return that the CRA deems should have been electronically fileable, and we do not have a good explanation, the CRA will fine H&R Block $20. So, while you, the regular taxpayer, you can do your return on paper if you want to, companies like H&R Block have to file them electronically if at all possible. So we are quite familiar with the list of things which cannot be electronically filed, and so refile is a simply longer variation on that list. Now, assessments. So when the return is submitted and processed by the CRA, then a notice of assessment is issued. If the CRA makes a change to an existing assessment, it's called a notice of reassessment, whether requested by the CRA or imposed, either requested by the taxpayer or imposed by the CRA. If the taxpayer disagrees with the assessment, they can file what's called a notice of objection, and this can be filed up to the later of 90 days of the mailing of the notice of assessment or 1 year from the due date of the return. So generally, this is not for things like adjustments. This is when you've requested a change and the CRA has disallowed it. In general, adjustments can be done for up to 10 years. So the notice of objection is useful in purposes, however, in situations where the CRA has, say, disallowed something that you have requested specifically. Notices of objection are important because they preserve legal options. So depending on the situation, it may be appropriate to file one. In general, it's only done when a taxpayer disagrees with an assessment or reassessment. This is, a regular adjustment is not necessarily because you disagree with anything in the assessment. But if, for example, the CRA makes an error or they reject an adjustment request, the notice of objection exists to preserve legal avenues. Within the first year after the due date of a return, requests for changes usually can be initially made doing a T1 adjustment request after the assessment. But if the 1-year deadline approaches and it hasn't been resolved, taxpayers generally should file the more formal notice of objection in order to preserve their right to disagree with the potential assessment. Now, adjustment requests can be used to request corrections of an assessing mistake made by the CRA, but it should not be used if the time limit for filing a notice of objection is running out. And whenever an adjustment request is outright rejected by the CRA and the taxpayer wants to pursue the matter, then a notice of objection has to be filed. So when the normal adjustment process, request process fails, that's when you go to the notice of objection. Now, it's important to understand that a notice of objection is a form of legal action. So taxpayers who want to embark on this course need to do careful research or engage the services of a professional. Objections must be based on fact and tax law. They cannot be based on opinions or beliefs about what is fair. And this starts to get beyond the area of expertise for the average tax professional. H&R Block, we are not tax lawyers. We have some tax lawyers working for us, but by and large, that is not what our business is about. There is a certain level beyond which you will want to get tax lawyers involved. It's not that H&R Block never challenges things in court with the CRA, but depending on the situation, there are people who are even more equipped for it than we are. H&R Block's general business our general business model is that we provide services at an affordable cost to the average taxpayer, and our services are less expensive than those of chartered accountants or tax lawyers because they can do some things that we cannot do, right? A tax lawyer can handle certain things to do with tax that have nothing to do with income tax. A chartered accountant can handle certain accounting things which have nothing to do with income tax. At H&R Block, our specialty is income tax, and that's why our prices are more affordable. But if people need to go beyond us, then that tends to be expensive. So taxpayers need to consider very carefully if they're going to do that. If the notice of objection does not succeed, and there's no agreement, then the taxpayer can appeal. They can take this to the Tax Court of Canada or the federal court, and they do have the right to appeal an adverse decision to ever higher courts, all the way up to the Supreme Court of Canada. And so every year or two, we receive some interesting updates on interesting court cases which have come down from the Supreme Court of Canada, and this often leads to changes in the tax code. So, for example, the inclusion of people with type 1 diabetes as an automatic condition qualifying for the disability amount, that was the result of court action, I do believe. So, it can lead to changes. But the key thing is the appeal process is not to be done lightly. Now, in terms of interest on returns and refunds, the CRA pays interest on unpaid refunds starting at the later of the 31st day after the return is due, or the 31st day after the return is filed, or if there was an erroneous overpayment of tax, then the date on which the tax was overpaid. But notice that this is only paid 31 days after filing. So if you file your taxes 5 years late, the CRA will not pay you 5 years worth of interest. If you file your taxes 5 years late and the CRA takes 6 months to process them, they will pay you 5 months of interest. Right? That's kind of the rule there. Now, however, by contrast, the CRA will start charging interest the first day after the filing deadline, unless there's been a waiver of some sort in a given year due to some unusual circumstances. So this is going to be May 1st in most years. And self-employed taxpayers and spouses, even though they do not have to file until June 15th, they will also be charged interest on the same payment date. CRA interest is charged at a prescribed rate, which is determined at the beginning of every quarter, and that can be found on the CRA website. So that's if you have a balance owing. Now, if you have a balance owing and you file late, there's an additional penalty. So the normal late filing penalty is calculated as 5% of the balance owing plus 1% of the balance owing for each full month the return is late, to a maximum of 12 months. That is a maximum of 17% of the balance owing. Notice, a balance owing of 0 means that the penalty is 0 because 5% of 0 is still 0. So this means for individual T1 returns, this is not true of trust returns or corporate returns, but for individual T1 returns, if it is a refund or there is no balance owing, then there is no penalty for filing late. Now, if something is filed late this year and one of the last three tax seasons, and there was a demand to file letter, the late filing penalty is calculated as 10% of the balance owing plus 2% of the balance owing for each full month the return is late, to a maximum of 20 months. That is 50%. So that's pretty significant. But again, this is only going to be assessed if the taxpayer repeatedly files late in consecutive years, or if there's a demand to file a return. One other thing to mention, these penalties we're talking about only apply to the tax return itself. There is a separate administrative penalty in some cases. So for example, if you file a T1135 late, that is a separate penalty, which doesn't fall under this list. If you file an election late, there will be a separate penalty. We'll talk about that a little bit later. But here we're only talking about tax that is owing in the year. And again, only for individual returns. If you file a trust return late, it's penalized whether those taxes or not. Now, if there's a repeated failure to report income, taking a step back, one of the adjustments you can make to a return is to include a T4 that wasn't included earlier. And you might say, oh, why would I want to bring this to the government's attention? Well, it's better to bring this to the government's attention before the CRA finds out about it. Because if the CRA notices that you have not filed a T4, and if it's on an information slip, eventually they will, the CRA can potentially assess a penalty for a repeated failure to report income. So if you fail to include an amount of income of $500 or more on your current return, and also failed to include an amount of income of $500 or more in any one of the previous 3 tax returns, right? So if you once it's okay theoretically, but if it happens again, if there's a pattern from the CRA point of view, then they will assess a penalty. However, notice this $500 minimum. It does need to be fairly significant. That didn't apply until relatively recently, but I think that was simply added in for administrative convenience. Sorry, I just need to make a note in my files here. Okay, so the $500 threshold was brought in just to make sure that small accidental omissions didn't qualify. It's just significant income being repeatedly omitted. So the penalty then is calculated as the lesser of 10% of the unreported amount of income, or 50% of the difference between the understated tax related to the unreported income and the amount of tax withheld related to the unreported income. So if the amount doesn't involve a significant amount of tax, then the penalty is going to be relatively small. And consider that $500 threshold. So 10% of $500 would be only $50. So you can see omissions that were less than the threshold would not have faced a significant penalty in any case. The CRA is not therefore looking to crack down on people who forget to include a missing T5 for like $3 or something like that. Although the CRA would, certainly prefer that you include it, but they're not going to penalize anyone excessively for that kind of thing. Note, however, that there will be an additional provincial penalty depending on the situation. UAMA has a question. What is normal late? Sorry, I'm not quite sure. I'm not sure what slide this is referring to. So normally a return is late if it is filed after April 30th. Yeah, so the penalties for 5%. Right. Yes. Okay. I'm with you now. Let me go back a slide. Click. Yeah, so the normal late filing penalty, right? So that's for someone who doesn't have you just file late 1 year. This is what's going to happen. It's 5% of the balance owing, right? So that's usually what happens. The heavier 10% penalty only applies in cases where someone is late again and again in tax seasons, or they've received a demand to file letter from the CRA. The demand to file letter is a letter that the CRA sends where they tell a taxpayer that, hey, we're pretty sure you owe us money, file this tax return or else we will do it for you, and you won't like that. So the normal late filing penalty is what, usually applies to someone where it's, not a repeated pattern of behavior. There's no other circumstances. What is the word? It's not extenuating. It's the opposite of extenuating. Aggravating circumstances? That's going to bother me. Okay, anyway. But yeah, so that's all we mean. Normally, the late filing penalty is 5%. All right, now, given all of this, then, it's helpful to know about something called the Voluntary Disclosure Program. Remember what I said. It's generally better to tell the CRA about something that's missing before the CRA finds out about it. So if you do this using the Voluntary Disclosure Program, or VDP, you use the form RC-199, and you let the CRA know that there was some income or some other thing which wasn't included with the return but really should have been. If you submit this form, you will generally say, here is something we did not include, and here are the reasons for doing that, and we would like to request a waiver of the interest and penalties. And the form itself is pretty good because it walks you through the conditions that have to apply. So in order to qualify for the voluntary disclosure program, there has to be an amount that is past due, so you can't do it for a return which isn't due yet. And there has to be a penalty associated with it. So for example, you could use this if, say, someone hadn't done a T1135, you could use this to say, this was already due and it should have been done and there is a penalty associated with it. It also needs to be voluntary. So you have to bring it to the CRA's attention before the CRA brings it to your attention. So if they've sent you a demand to file, it's too late, the jig is up. But if they haven't noticed it yet, you can use this program. It also needs to be complete. You need to tell them about everything that's missing. You cannot hold anything back or do it all in stages. You need to come clean and tell them everything, and you need to include payment for the amount that is owing. And if you do that, then generally there will be no additional interest and payment assessed. So for example, if someone was missing, let's say, rental income from a given year because they had a foreign property and they didn't realize that it had to be reported in Canada because they had gotten bad tax advice, then you might submit this form and say, here's the situation. My poor client, a naive new person in Canada, was unaware. They got bad tax advice from their accountant back in other country. And so here we are declaring this rental income from this property, and we would like to pay the additional tax on it. And by us doing this, we would like you to waive the administrative penalty for submitting a T1135 late. That would be an example of something we might do this. Now, there are two tracks to the voluntary disclosure program. This was changed a few years back. Essentially, what I've just described is how the voluntary program applies to regular taxpayers in a regular situation. However, if there is a major issue of non-compliance, a major omission that rises to the level of criminality, the other track of the voluntary disclosure program is more of a stay out of jail option. You bring it to the CRA's attention. You say you're very sorry. You make payment, and it does not exempt you from interest and penalties, but it does keep you out of jail, basically. So those are the two tracks available. It does, by doing this voluntary compliance, then the CRA will not take legal action against you and will not attempt to assess criminal penalties against you. So, all right. Now, one of the things legally, speaking of legal, that underpins all of this is a section of the Income Tax Act called the Taxpayer Relief Provisions. And I think these, I don't know the legislative history exactly, but my impression is that these were a later modification to the Income Tax Act. These provisions allow the CRA to waive or cancel penalties and interest in certain circumstances. So if the taxpayer is prevented from filing or responding on time by an extraordinary circumstance, or the taxpayer was prevented from filing or responding to the disruption in services, this, for example, is the provision that allows the CRA to extend the tax deadline in case of some kind of natural disaster, or the CRA having a security breach, or when COVID came in, they extended the tax deadline by a month, which is a whole other topic. But basically, this legislation allows them to do that if the interest or penalty results from relying on incorrect written responses from the CRA or interest in their publications, or if the interest or penalty was due to a CRA error. Now, we're going to talk about these things on just before I move on from this slide, so this waiver of penalty and interest is by no means automatically granted. It's generally granted only in special circumstances. Examples are listed in the textbook. Just because the taxpayer requests it, it's not going to be automatically granted. Now, it doesn't hurt to request it, but for example, 1 year with a T1135, we had an associate who suffered a health event, and because the T1135 is not automatically filed with the return, the client thought the T1135 had been filed. H&R Block had no awareness the T1135 hadn't been filed, but the associate had the health event before filing the T1135. So we had to make a request for relief, and we, H&R Block, had to provide evidence that our associate, in good faith, was going to file the T1135, but was prevented by a health episode. So, you do have to substantiate it that something extraordinary happened. Now, for written responses, just to clarify here, that advice given by a CRA agent over the phone does not qualify. I have had contradictory advice from CRA agents over the phone. I have had advice from CRA agents which told me one thing, and then 2 years later, when I spoke to the actual specialist at the CRA, they were like, oh, no, that's not the case at all. So if you are getting CRA advice over the phone, if at all possible, have them send the advice in writing or send a reference to a published document clearly specifying the relevant segment of the Income Tax Act that you're drawing on. Now, you can also, under these provisions, request refunds on returns that are filed late, providing they're within 10 years of the end of the taxation years. Now, in most cases, a late refund from the request is automatically granted, providing there's adequate documentation. And it is only because of the taxpayer relief provision that we can file tax returns older than 3 years old and get a refund. And make adjustments to returns that are older than 3 years old. Right? This is the legal basis for us to be able to do things that are more than 3 years old. However, notice that certain things are what we call statute barred. They still have a lower time frame. So overpayments of CPP contributions cannot be made older than 4 years. Overpayments of EI premiums cannot be made older than 3 years. The BC sales tax credit, we cannot make a request for those refundable credits more than 3 years old, and so on. So there are some things where you cannot go back more than 3 or in some cases 4 years. In general, though, the window is 10, and it is based on the calendar year. So for most software packages, you have to be careful. If you're doing an old return and you're dealing with a CPP contribution or an EI premium overpayment, you got to be careful, and sometimes you need to do some manually work around it manually. Now, so what this is, that 10-year limit has some interesting implications, and has some interesting implications. So, for example, if I want to make a change to the 2015 tax year, I've got 10 calendar years to do so. So this means I need to file that adjustment by December 31st of this year, if it's for 2015. Because after that, the 10-year window will have closed. What this does mean, but it is based on the postmark. So if you have a situation where you're waiting on an adjustment to get processed or something else to be approved by the CRA, and it is getting near the end of the 10-year window, it is generally better to put that adjustment request in the mail and have it sent to the CRA before December 31st, just so that they have it, right? The CRA is restricted by the date of the submission and the postmark, not by their processing time. So the CRA cannot legally just run out the clock and say, oh, gee, this adjustment was a little complicated. It took us more than 10 years. Oops, butterfingers. They can't do that. But you do have to submit within the 10-year window. So if you have a case where you're coming up at that window, you need to get something. You need to at least make the initial request before that window closes. Now, be aware that just to make this clear, returns more than 10 years old can technically be filed, but this is very unusual because there's no refund possible. And according to some advice I got from a CRA person online over the phone once, the CRA cannot even collect a balance owing if it's more than 10 years old, although that one I'm a bit reluctant to test out. In general, then, there's not usually going to be a reason to submit a return that's more than 10 years old. There should always be a compelling reason to do so, such as maintaining a tuition credit. So, for example, if you've got a tuition credit from 2012 and you want to claim it now, but you didn't file for a few years in the middle there, you would have to file something for those years to show the CRA that you didn't have to use that tuition credit, for example. Or for an RSP contribution, things like that, which never expire. Then it can be good to just file something for those intervening years to show that it didn't need to be claimed, so that you can carry it forward to a window where it can be used. You might also file older returns in cases to establish residency, either to qualify for CPP or OAS, or for immigration purposes. So there could be reasons to file a return more than 10 years old. I've never gone older than 12, and it's still extremely infrequent. I do maybe one of these every couple years or so. The processing time for these very old returns is obviously very slow because they have to be done on paper, and if anything unusual is involved, even more so. And the CRA computer systems may have trouble handling it, and the CRA also typically does not maintain online access to information slips more than 10 years old. If you go back and look at historical tax packages on the CRA, currently only the last 10 years are maintained on the CRA website itself. Anything older than that, they have a link to it. It's maintained by Archives Canada now, so currently you can access them as far back as 1985, but all it would really take is one overzealous Minister of Finance to close that window. So elections, just to touch on these briefly, remember an election is an optional choice which can be made by the taxpayer. The Income Tax Act allows taxpayers to decide how to treat certain things in their return. So, for example, the principal residence designation, that is an election. If you want to take your principal residence and convert it into a rental property, but be exempt but still maintain the principal residence designation, there's an election for that. There's over 120 elections in the Income Tax Act. Only a few of them are going to be applicable at our level. But under taxpayer relief provisions, you are still allowed to make some elections after the normal time limit and revoke or amend certain previously made elections. However, this is often subject to a penalty. So in these cases, it's important to determine if the tax advantage is going to exceed the penalty. So if the late penalties are going to be more than the tax you save, then it's better not to make the election at all. All right. So on that note, any questions, gang? All right, let's see what our time is like. It is 8:22. So chapter review problem 15-1 is an interesting one where we gave you a tax return and you were to look at it and see if you could find the mistakes. Now, I don't know if you guys have had a chance to do that yet. I would like to give you a few minutes to have a look at the problem. if you haven't already. So remember in the textbook, pull up the textbook here for a second. So for anyone who hasn't had a look at it. WebEx, there we go. This is actually not an uncommon situation for us. Now that you've taken a tax course, people will sometimes just ask you tax questions. So Ashley Jones here moved from Nova Scotia to your province and brought all her belongings and officially changed her residence to your province by the end of 2024. She filed her taxes in February in BC. She worked as a counter clerk at a donut place. And she had some childcare expenses with her neighbor, and she had some medical expenses. And here's the key thing: she prepared her own income tax return this year for the first time, but she has not taken this course. So when she shows you her tax return, you can tell that there are some mistakes. So what I would like you guys to do, so Downtown Donuts here, in your province, although I think the intent of the problem is that this employment income was in the original province, but leave that to the side for the moment. So have a look through her tax return and see what mistakes you can find. It is 8:24 now, so I'll give you 5 minutes, and then we'll go through, okay? Sound reasonable, everybody? Okay, Ali Reza, just pause the recording here, and we'll pick it up. And thanks, Ali Reza. Okay, so as usual, with our methodology, the first thing to do is look at the problem and figure out what should be on the return and what shouldn't be. So for example, what income is she required to report? So guys, what would we expect to see on the return in terms of income? So tips, right? We should, our first thing to do will be to look on line 10400 to see if there's tips. What else will we expect to see? Good, Kate, right? So what other income is there going to be? Income first, not, we won't get to the deductions just yet. So box 14 is the T4, right? The T4 income, that's going to show up on, what line does T4 income show up on? Regular employment income? Well, let's not look at what's missing just yet. What are we expecting to see, right? The employment income on line 10100, the tips income on line 10400. What about the WCB income? What line is that going to be on? So that should be on line 14400. Now, is any of the income non-taxable? So we have our three sources. Good. WCB isn't. So we would also then expect to see the WCB income showing up as a deduction, right? So we're going to be looking for that on line 25000. For personal amounts, what should we be looking for? Eligible dependent, right? So the basic personal amount for herself, and most people do get that one, but she may be unaware of the amount for an eligible dependent. So that should show up on line 30400 for one of the children. Now, medical expenses. Which are the things that she can claim? Is there anything that she can't claim? the non-prescription medicine, right? Herbs and medicines can't be claimed, right? And that's the one which can't be claimed. The dental work, the glasses, the prescription drugs, these can all be claimed. All right, so then, with all that in mind, what errors has she made that you can find on the tax return? So just drop all the errors you can find into the chat, and then I'm going to go through over the next few slides to show them. Okay, so there should be a CPP overpayment. The tips are missing. Good, good. Childcare expenses should also be in there. Actually, the slides are organized by page, so maybe we'll go through by page. Good. So on page 3, we would expect to see the tips, right? And those are missing. On page 4, we would expect to see the childcare expenses. Those are missing. The CPP enhanced contributions, we would expect to see those. Good. On page 5 is where we would expect to see the workers' compensation deduction. And you'll notice that these errors in this stage of the return will cause other errors later on in the return. So errors in calculating total income will carry forward to all the sections that follow. They are downstream, so any tax calculations based on taxable income, for example, are going to be incorrect because of an error made in total income. When I had to mark exams on paper, this was a principle that I had to keep in mind, and it did make it a bit of a challenge because, you know, we only want to penalize the initial mistake. So if a student is wrong with their total income, then everything after that based on income is going to be incorrect. For the tax credits, if he's missing the amount for eligible dependent, then this is going to throw off the rest of the non-refundable tax credits, right? So the net income then should be a different amount than what she has there, right? But it's because of these earlier mistakes and omissions. For her non-refundable tax credits, the CPP, it's incorrect. Can you tell why it's incorrect? Because there's a couple things going on there with CPP, and maybe just in the interest of speed, I can give you that. So for the CPP, right, exactly, that's the heart of it. So the original payroll deduction is incorrect. If you do a Schedule 8 on it, you would see the original payroll deduction is incorrect. So that's not her fault, but part of that contributions should be on line 22215, and she did miss that, right? And again, that's a relatively recent change, so some people may be unaware of it, even though the tax return does try to spell it out. So if someone does a Schedule 8, in theory, they should realize that some of it goes on line 22215. She also missed the Canada Employment Amount, which is a very frequent credit that is omitted because even today, a lot of people are still unaware that this is a credit that they qualify just by having employment income. The medical expenses amount is incorrect at line 33099. Because she includes the 400 and she shouldn't have. And she didn't reduce the possible medical expense claim by 3% of her net income. So from this point forward, because the line 35000 amount is incorrect, all the subsequent calculations involving the credit, involving non-refundable credits will be wrong. Lastly, there's nothing going on page 7, but on page 8, for refundable tax credits, the income tax deducted has a typo in it. She did not detect the CPP overpayment. And the refundable medical expense supplement and Canada Workers Benefit, she should qualify for those, but they are missing entirely. And in this example, just keep it simple, we're disregarding provincial amounts on line 42800 and 47900 because she didn't do them. but in the field, we would want to look at those as well. So when we are submitting the adjustment for Ashley, we want to think about what tax forms we need to attach to it. So remember what we were talking about with tax forms to send in? We typically don't send in worksheets, we send in schedules. So what schedules, based on what we've been talking about, what schedules would we expect to send in with it? So for that Schedule 5, right, for the eligible dependent, the T778 for the childcare expenses, good. Schedule 8 for that CPP overpayment. There's one more big one. No, Schedule 9 for charitable donations, and I don't think there were any of those here. Or were there? It's not an error that we need to fix. Schedule 6, good. For the Canada Workers Benefit, Schedule 6 needs to be done. We would only submit Schedule 9 if there was a mistake that we needed to fix in regards to charitable donations. So, but Schedule 6 we would need to do for the Canada Workers Benefit. Oh, okay, yeah, yeah. There's supposed to be a 6. No problem, no problem. Okay. The federal worksheet, you could send it in just to show the CRA your work, but it's not actually required. Now, since schedules are a CRA form, we don't need to send in additional information because the online tool, when we're making a change online, will only require information from those forms. The other supporting documentation we might need to send in. We might not need to send in the federal worksheet for the refundable medical expense supplement, although it probably can't hurt. We will need to send in the medical receipts to show how we arrived at that total. And for the childcare expenses, we will need to send in that receipt as well. If we are making the change online, however, we do not submit them when the initial request is submitted, only if it is requested. If we are sending it in on paper, we can send it all in at once. So with that in mind, would it be better to mail in the adjustment or request it online? So, and again, just in the interest of speed, the online adjustment requests, we need to consider this carefully because the CRA hasn't finished processing her original return. So we can't do an online adjustment request yet. However, an online adjustment request has the major advantages of speed and tracking. A mailed-in adjustment could get lost, will take significant longer. So a mailed-in request sends in all the information. We know it's gone in. Assuming there's no postal strike going on, it's probably going to be fine. But it will take more time. The advantage is that it's relatively more certain. Online requests, by contrast, we cannot start those until the tax return itself has been assessed. So even so, probably the original return will be assessed within 10 to 14 days. And then we can look at the notice assessment and see if the CRA has fixed any of these errors to begin with. Probably not for most of them, but anything where the CRA could reasonably detect something, they might fix it. So that also might affect on what we actually ask to have adjusted. At this level, we're not going to be expecting you to do too many adjustments, but we do want you to be familiar with the process behind it. And what we really want you to be able to do is identify when there have been mistakes on return and when a change is going to be required. So that's the key skill we want to work on here. It's like, can we see when there has been a mistake? Right. So if you'd want to check anything to do with that problem, though, you can just shoot me an email and I'll be happy to give you more detail if desired. A T180J is not so complicated. I believe there's an example in the textbook to have a look at it, right? So have a look at the textbook, and if you still have questions, do just let me know. But for something like this, say, we would go through line by line and say, okay, the tips are missing, so we would request a change to line 10400 and change the amount from 0 to the amount of the tips, right? And you would just go through line by line by line and do that. Because we are coming up on 9, and I do want to review the assignment, I'm not going to do that with you right now, but if you do have questions, let me know, and we can also do it in a subsequent class if you're really too many lines, one page isn't enough. Well, if you're generating a T1 adjustment in software, it will automatically add lines to extend the form. Otherwise, you can attach a second page or even a second page 1 of the form. There's ways around it. Yeah, one page. Why not? You don't need to feel physically constrained by the form. There are ways around that, and the CRA does appreciate that sometimes there's just a lot of lines to be changed, so that's okay. Yeah. All right. Yeah, and this is just an example. All right, we already had a 15-minute break, so we're not going to need a second one. So before we move on, then just a poll question, see how well you remember. So for 2024, for which years can you claim a CPP overpayment? So is it 2015 to 2024, 2019 to 2024? Is it 2020 to 2024, or is it 2021 to 2024? Ten seconds left. One section of my notes has wandered around somewhere. All right, so the correct answer here, here we are. There we go. Yeah, that'll teach me to put 2 lessons in one folder. So the correct answer here is D, 2021 to 2024. So remember, for CPP and EI, your time limit is restricted from the normal 10 years. All right, so on that note, we are going to review assignment number 2. But for those of you who are downloading this online, I'm going to wrap things up first. So in chapters 14 and 15, we've talked about how to submit your tax returns and your payments to the CRA. And as always, just remember, there's more details in the textbook than we're able to get to even in a 3-hour session. You also have an understanding of the process of what happens to a tax return after it's filed and the options that you have to change or adjust the return if the original return needs to be amended. This can either be done electronically or by refiling the return or submitting a paper adjustment request. You should also understand the rules for interest and penalties and how those apply, remembering that for an individual tax return, There is no penalty or interest assessed if the balance owing is zero or it is a refund. You should have some idea of the general procedure for what happens if we disagree with the CRA, so assessments, objections, appeals, the options available to try to get out of a penalty via voluntary disclosure, and you should have an understanding of time limits, how they work for refunds and elections and so forth. Also, you should now be familiar with the advanced topics from the provincial supplement and generally how to use the provincial supplement to find out more information about provincial topics. And as well, you have some idea of the tax changes that have been proposed for 2025. And again, those have yet to be finalized, so there will not be questions about that on the exam. But speaking of the exam, it is open book and it is 90 minutes long. Now, you have two chances to do the exam, and this can lead to confusion. So I want to be very clear about this. If your status is failed the first time you take it, that only means that you failed to get 100%. This is just how the platform works. In order to allow you to take the exam a second time, your status has to be failed. And we ran into trouble the first year we used the online system because people would get, say, 75% or 81%, and they would want to take it again to improve their mark, to improve their chances of getting hired. And the system would say, nope, you've passed, you can't write it again. So we now have it set so that if you do not score 100% the first time, it'll show your status as failed. But if your status is, say, 99% and you're not really concerned about that second try, you don't have to worry about it. Remember, that is just a flag that allows you to take the exam a second time. Your maximum attempts are 2, so you can only take it 2. So for those of you online, please look at your individual class schedule to see when the theory exam is due. For my students here, today is Thursday. Your exam is due by next Wednesday, the day before our next class. Technically speaking, it is due before class begins next Thursday, but if I say that it is due next Thursday, then if that were in the schedule, people would try to write the exam after the class, and we can't have that. So you have a week, essentially, my students. Everyone in other sessions, please check your individual schedule. But generally, for each class session, there will be a class, a normal class. There's a space where you would normally have a class. That is the class time we are allocating to write the exam. Now, there are no extensions on the exam. If you have some kind of technical issue, your computer fails, things like that, please let me know via email, but also contact TAC East at the contact information in your learner's guide, because they can reset it for you. I cannot do that. So when you're emailing me, you're just letting me know there was some sort of issue, but you should take steps to contact the technical support people so that they can reset the exam so that you can take it. If due to technical reasons you're unable to complete it by our next class, you need to let me know, and then we will proceed from there. But in general, no extensions are permitted, barring extraordinary circumstances. And certainly, if you do not contact me or anyone else, and just ask to write the exam 2 weeks from now without any sort of explanation or reason, we are going to say no. It is very much open book. It says right here, open book, and we mean it. You can have your notes open, you can have your textbooks, you have full access to your textbooks. This is not a test of memorization. This is not a civil service exam. We want you to develop the skill of looking up information quickly and efficiently. So if you know how to find information in the textbook or the other supporting supporting documents, so in the facts and figures, in the Tax Academy reference, in the CRA website itself, that will serve you well. It is a timed exam. You only have 90 minutes. So if you need to take 10 minutes to look up the answer to every single question, you're going to run out of time, but you absolutely will have time to look up something here and there, or check what a line number is. So even if you just have a copy of a T1 with you that you can refer to, keep your notes open, things like that, that will serve you well. And Lee, questions, these are generally multiple choice questions or true and false questions. I don't think there are short answer questions here. I forget the actual number of questions, but everyone has the same number of questions, although the selection of questions you have will be slightly different. So everyone's exam is going to be slightly different, and if you take it the second time, you will not get exactly the same questions. Be advised, some questions look very similar. So if you're taking the exam a second time, look very closely at the question and don't assume that it's the exact same question that you had the first time with the exact same answer. Be advised. And Leanne, you're asking, double checking, if it's not 100% and it says fail, you can still take it again without contacting anyone? Yeah, that's my understanding. You can take it a second time. I do not suggest that you take it immediately. I suggest you take a break, study a bit, rehydrate, get a good night's sleep, and then take it fresh. So do not leave the exam until the very last minute. Yes, it's 90 minutes for each attempt. You don't have to squeeze both attempts into 90 minutes. That would be crazy. No. Yeah. So you have 90 minutes for each attempt, and if you get 100% the first time, you don't need to take it again. And if you get 99% the first time, you really don't need to take it again, I would say. Now, just to be clear, because some students were asking me, your instructor has full, and this is more for the online students, your instructor has full discretion over the exam, and they manually enter the grades. So if you score lower on the second attempt, they will, of course, take the higher attempt. So do not worry, there is no risk to taking it the second time. If you write it a second time, you get we will simply manually take the higher score. Although if you score less the second time, we will sigh sadly to ourselves, but we will always take the higher score, so there is no risk involved there. All right, but also just read and follow the instructions in your learner guide and the exam instruction booklet carefully, because it's got more detail, and it will we took time writing those, so please do read those, because if you forget some detail, it's all in there. If I've forgotten to mention a detail, it will be in there. Okay, all right. So on that note, for our online students then, I will just tell you this now. So after you've done the theory exam, you can it'll allow you to open up the software, so follow the software access instructions in your transcript. It's best if you can do this 48 hours before our next class, so that you can have access to the software when we do the next class, but I would take that more of a guideline. Your priority is to get the exam done and do well on the exam, so take whatever time you need to study, prepare, and if necessary, prepare a second time and take it a second time. So prioritize the exam. And then next time we're going to be looking at typical software packages. So well done. We're through the theory portion of the course. And Reza asks, the final result is calculated automatically, or you have room to add the score to the final results? Generally speaking, we will take the score that has been calculated. For grades for the course, we do manually add. I want to keep this brief. We do manually add together the scores from the from both assignments and the exam. Right? So generally, however, we're not going to give out bonus questions or bonus points or anything like that, but we do manually enter the results. So. For example, in a case where if we were to discover that there was some question which was unfair, that students should be getting a point for, then we would look at that. And students sometimes come to me and say, hey, this question here, I really should have gotten a point for this, but it didn't go through correctly. What's going on? I can have a look at that. So we're not locked into what the computer does, but generally we're only going to change that number if there's a good reason. All right. So then, for our next class, then, online people, will be the introduction to tax preparation software. We're going to be using H&R Block software because it's a fairly typical package. You have to attend our software training sessions to be considered for hire with H&R Block. Even if you don't want to come work for us, I think it's probably worthwhile to do these sessions just so you can see how all this tax theory works out in practice with a typical software package. All right, so for those of you online, my students here, you don't have to run away, but for those of you online, I will bid you all a good night and a thank you, and we're going to pause the recording in a second. Good luck with your exams, and remember, if there's it's too soon. All right, well, I'm sure they're smart. Okay, so thank you. Yes, so sorry, I think we got cut off there. Yes, so remember, if you have a technical issue, your instructor cannot reset the exam, please contact the tech support people via the contact information that's in the learner guide, because that's why we put it in there. So good luck with your exams, everybody, and I'll see you guys in a week. Okay. Well, all right, so that's it for the online portion.